Vanguard founder Jack Bogle once said, "Why look for a needle in a haystack whenever you can buy the entire haystack?"
Goes out to all our fallen homies, yo. Come on.
Hey, yo, real talk.
All right?
Yeah.
It just seems like a waste, right?
Does that make me a dick?
Oh, dang, come on, man.
Leave it, dude.
I mean, it's not gonna bring it back.
Stupid.
It's not gonna bring it back.
My name's Adam Wilson and this is Broke Man Finance. If there's two things that I know about, one is being broke, two is how to get out of it. So let's start with mutual funds. Now, mutual funds is the oldest one out of the three. It was actually started in the 1800s when a group of people got together and decided they were going to bring all their money together and invest as one collective unit. Mutual funds is kind of the OG of all three of these.
I'm ready to get this money.
It's certainly the foundation and where index funds and ETFs are derived from. So a mutual fund is this. A mutual fund can consist of anywhere from 36 to even 1,000 stocks. The more diversified, oftentimes the more amount of risk is mitigated. Let me explain. If I'm invested in one mutual fund, index fund, or ETF, my money is going to be spread across many individual stocks. If I just have all that, if that same amount of money is invested in one individual stock, and let's say it's Kodak from 20 years ago, and all of a sudden here comes the digital cameras and phone cameras, and that stock just starts to plummet, right? So one time I think they were like $100, now they're a couple dollars.
I'm broke as shit.
So it takes that level of risk away. Two, you can be lazy. You don't have to go through 100 individual stocks and learn balance sheets, and all that's done for me. All I've got to do is just keep putting money in there. So mutual funds are going to be managed by people much smarter than myself. And they're going to pick their own individual stocks. Now, one of the downsides with that is there are fees that come along with that. If they're earning you enough money, you're okay paying 0.03%. You know, if you've earned a substantial amount of money with their help that you otherwise wouldn't have earned, you're okay paying that. At least I will be. There's value in convenience. Instead of owning just a couple stocks or having to pour into these balance sheets on where I really want to invest my money because I just don't want to waste it. Now, some people like that because it just takes the thinking out of it. Mutual funds may be expensive. You know, I've seen them for Vanguard. You got them starting anywhere from $1,000 initially to $3,000 to even more. Those minimum investment amounts are gonna vary depending on what brokerage you decide to go through. And let's say it's $3,000. You can then in turn take whatever amount you can afford and just start dumping it in there and actually getting it automatically pulled out of your banking account or whatever. All right, let's go back over it. Mutual funds are going to be, they're actively managed funds by people hopefully smarter than we are and who's going to make you money. At the same time, you're going to have to give them money because they're not going to do it for free. That's how they make a living. So there are going to be some higher fees involved, but oftentimes they've outperformed index funds and ETFs and the stock market as a whole. So you can get into a mutual fund like with Vanguard as low as $1,000 to $3,000. I know that may sound like a lot of money to some people, but after that initial minimum investment, you can start throwing however much money you would like to at them and just keep building that mutual fund and building that portfolio. There's instant diversification amongst mutual funds, index funds, and ETFs because it's a collection. Like I said, it's a collection of stocks. It's not just one or two individual stocks. That is a big deal to somebody that's especially a new investor. You take somebody like Dave Ramsey, he doesn't even believe in getting individual stocks because he believes there's too much risk involved.
I'm spending just insane amounts of money, about $10,000 a month on prostitutes and strip clubs. All
right, let's move forward a little bit and let's talk about index funds. Listen to this quote by Warren Buffett whenever he's discussing what he's going to do with all that money whenever he dies. He gets asked about it all the time, so it's not like I'm being morbid. He's going to tell his beneficiaries, basically, put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. He suggests Vanguard, as I do. I believe the trust's long-term results from this policy will be superior to those attained by most investors. So the S&P 500 is a collection of the 500 biggest companies, large cap companies. So essentially, when you buy into that index fund, you're buying shares of all 500 companies. Now, why would Warren Buffett believe so much in this one index fund? Well, for the past 40 years, it has averaged 10% return across the whole spectrum of stocks. Now, some of those individual stocks may have done really, really well. Some of them may have done really, really bad. But collectively, you're still looking at a 10% return on that investment. 40-year track record. Are there going to be bad years? Yes. Are there going to be good years? Yes. Double-digit bad years? Absolutely. Double-digit good years? 100%. Index funds is not actively managed. It's passively managed, meaning that if your index fund is tracking the S&P 500, well, then your companies and your stocks, they're already paid for you. So you're just riding with those top 500 companies. Like, I get the thrill or the draw of trying to pick some kind of stock, and people, especially new investors, they'll just go throw some money in something random or from something somebody told them to do, and maybe it works out for them, especially if it's a bull market and everybody's picking great stocks. But in reality, you're probably not the best. You're probably not Warren Buffett.
A doctor will tell me that I have an IQ of 48 and am what some people call mentally retarded.
Let's just be honest, especially if you're brand new. Again, I would suggest Vanguard for my brokerage account if you're looking to throw into an index fund. It's going to be similar to the mutual fund. There's going to be a minimum investment. In 2019, they actually lowered their minimum initial investment. It used to be $10,000, and for most people, myself included, that will be a very, very hard minimum to make if you're a regular 9-to-5 blue-collar person. What they did was they dropped from that $10,000 minimum investment to $3,000 minimum investment, which, granted, I know it may still sound like a lot, but once you make that investment, afterwards you can just throw whatever you want to at it. Similar to the mutual fund. It's going to depend on what you can afford at that time. And you can set that up to be on an automatic deposit, which is probably one of the more bigger pros versus an ETF. So let me explain that, and hopefully it'll make a little more sense. So an ETF stands for Exchange Traded Funds. They're very similar to an index fund, the way they track the market. Specifically, going back to the S&P 500, you can buy ETFs that's what they do. They track the S&P 500. You can get ETFs that track the entire market, emerging markets, oil, bond. There's lots of ETFs you can get. Again, Vanguard, not sponsored by Vanguard. I just really believe in the company. They've been around forever, trillions of dollars in assets. Not going anywhere. ETFs buy and sell like shares of stock, but they're not like a stock. So what I mean is this. It's not like an ETF is a piece of a company. It's not. Whenever you buy a share of McDonald's stock, you're buying a slice of that McDonald's pie. If you buy a share of Apple stock, you're getting a piece of that company. Now, an ETF, you can buy, sell, trade as much as you want to, as opposed to an index fund that limits those amount of transactions per day. And now, if I'm remembering correctly, it's only like once per day, I believe you can trade and you can buy and sell those index funds. Feel free to correct me in the comments. So a lot of people get turned away from the ETFs because they got to buy that full share of that stock price, as opposed to having that index fund or mutual fund, and you can throw whatever you want to at it after you make that initial investment. If you've watched my other video with fractional shares, I am a very big fractional shares believer. I love the flexibility it gives me in my money. I can put $5 in this, $5 in that, and I can also do that with my favorite ETF, VOO, Vanguard's S&P 500 ETF. It's had a great return year after year. It's got a decent little dividend attached to it. The fee is very, very minimal. You're not even going to miss it with the amount that you're probably going to make off of it. And if you have those fractional shares, it's much easier to just bite off pieces of it. That's why I'm such a big fan of the fractional shares. Get fractional shares like every day. Like right now, I think that VOO is trading for around $262. If I didn't have fractional shares, that means I would have to go pay $262 for one share. And that may mean, okay, if I've only got it $100 each week to play with, Well, I'm gonna have to wait 3 weeks every time I wanted to buy a share. But this way, if I want to spend 25 bucks a week on that stock, I can purchase $25 every week and still benefit from that S&P 500 return. Go get fractional shares if you are
Broke as shit.
trying to make the most with your money. It makes the most sense. For instance, if I can't afford to pay $262 per share for VOO, I don't have to. I can throw 25 bucks at it. I can throw 20 bucks at it. Sort of like it would be if I had that mutual fund or that index fund. I don't have to come out of pocket that full share anymore. Also, I don't have to come out of pocket for that entire initial investment. Another thing I like about this ETF is the fee is so low on it. It's much lower than a lot of other ETFs, mutual funds, and index funds. That's why I like fractional shares so much, is because I don't have that minimum investment that I have to make, but I can throw whatever I can afford at that ETF still and reap those returns and reap those benefits. If you're just an emotional basket case,
Why are you crying?
and as soon as you see that share start to drop, or you see that graph start to trend downwards, and you just sell automatically, then by all means, please get a mutual fund, get an index fund, set you an amount up to invest in it, and just forget about it. But if you're like me and you don't want to pay that $3,000 initial investment to get into that one fund, then I would look at the ETFs, because it's going to track the same thing. It's going to track that S&P 500 or whatever ETF you decide. There's many that track many different sectors. Now, you are charged a little bit, but if you're making money, it doesn't matter, because for one, you're earning off that appreciation, you're earning dividends on that money, and you've mitigated a lot of risk. That peace of mind from mitigating the risk and investing in that ETF is worth the small amount that you're going to end up paying in fees. I promise. All right, guys. My name's Adam. Hope this helps. Like, subscribe. Talk to you soon.